Australia is set to overhaul its capital gains tax system, and cryptocurrency investors are among those who will feel the impact. The reform package, announced as part of the 2027 fiscal year budget, will affect gains realized after July 1, 2027. Under the current system, investors who hold assets for more than a year receive a 50% discount on their capital gains tax liability. The proposed changes eliminate this discount in favor of a cost-based indexation system tied to the Consumer Price Index. This shift could significantly increase tax obligations for investors, especially those with lower incomes who may see a greater proportion of their gains taxed at full value. The government argues that the new system will more accurately reflect genuine investment returns by accounting for inflation. However, for cryptocurrency investors, this could mean a reduction in the profitability of long-term holdings. The reform also introduces a 30% minimum tax threshold, which could further impact the returns of digital asset investors. As a result, many may be incentivized to adopt shorter holding strategies or seek alternative methods. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Of managing their crypto wealth. Self-managed superannuation funds may become more attractive as a result of these changes. Investors could shift their digital assets into these funds to optimize their tax outcomes after the reform takes effect. The changes are expected to apply to all capital gains tax assets, including cryptocurrency, equities, real estate, and trust holdings. The reform is part of a broader fiscal strategy aimed at aligning tax policies with economic realities, but its effects on the crypto market remain to be seen. The key uncertainty lies in how investors will adapt to the new framework. Will they shift their investment strategies, or will they look for alternative jurisdictions with more favorable tax policies? The government's stated goal is to ensure that capital gains are taxed fairly, but the practical implications for individual investors, particularly those with limited financial flexibility, could be significant. The elimination of the 50% discount is a major point of contention. For example, if an investor realizes a $10,000 gain, they would currently pay tax on $5,000. Under the new rules, they would pay on the full $10,000. This could reduce the appeal of long-term crypto investments, which have been a key driver of growth in the sector. The government's rationale is that the indexation system will more accurately reflect real gains, but critics argue that it could discourage investment in volatile assets like cryptocurrency. The reforms may also influence broader market behavior. If investors perceive the tax changes as unfavorable, they may reduce their exposure to crypto assets or delay transactions until after the reform date. This could create short-term volatility in the market. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. As investors adjust their strategies. Additionally, the introduction of a minimum tax threshold may disproportionately affect smaller investors who are more sensitive to tax increases. The next signal to watch is how the government finalizes the details of the reform and whether there will be any exemptions or transitional provisions for digital assets. Investors will also be monitoring how other jurisdictions handle similar tax policies, as this could influence global crypto investment trends. The impact of these changes will likely become clearer as the July 1, 2027 implementation date approaches.